section is known as the strategic deal structuring, due diligence, and valuation insights. These are the experts that's going to be on the panel. And our awesome moderator is none other than the managing director of Pro CFO Partners, and he is Ryan Walter. Come on down, Walter.
Michael Buffer.
Kyle, I think I got a better intro than you did. So appreciate everyone coming back. Glad you all made it back from networking. It looked like there were some really incredible conversations going on there, but I know you're going to have an incredible session here with the panel as well. As you heard, we're going to be talking strategic deal structuring as well as due diligence and valuation insights. And I'm just going to turn it over here to let our panel just quickly introduce themselves to everyone.
Thank you, Brian McIntyre, partner at Witham. I lead our national valuation practice, including business valuation, real estate, and tangible assets.
Mary Soldano, SBA 7A lender. I gave you guys our spiel earlier.
Partner at OGC Solutions. We do small and mid-size outside general counsel solutions. So fractional GC on a subscription basis. I do a lot of buy-side M&A deals.
Kevin St. Cyr, Murphy McCormick Capital Advisors. I work as an investment banker in southeastern Pennsylvania. We do valuations, sell-side and buy-side advisory. In fact, since you're a bunch of advisors here, I have a highly qualified investor looking for his third acquisition. He's already bought and sold two. He was looking for a $10 to $20 million manufacturing company, tech company. He's got a lot of life sciences experience, but is agnostic on the market. If anybody wants a teaser, see me afterwards.
Nice. That's deal flow.
Deal making. All right, so let's start sort of on the strategic deal structuring side. And Mark, I'll probably start with you if you want to begin here. What are some of the most critical factors you consider when structuring a deal to balance risk and reward?
I think we started in the last panel. They were talking a little bit about stock versus asset, and that's kind of where it really starts there as the lawyer and the deal guy, right? So I kind of play both sides of this because actually we did a deal together. Well, we tried to do a deal together. It didn't work out. I won't say who was the problem. But no, seriously, it starts with assets and stock and what's the best kind of structure for the deal and what makes the most sense, right? And that's tax, which you talked a lot about last time, but it's also really big on liability and what are you stepping into. And so I do a lot of smaller size deals. So Mary and I work together quite a bit on SBA deals. So we've actually had ones that were assets we thought was going to be an asset deal, and it ends up having to be a stock deal because of a license or something along those lines where you have to assume something. So it really drives a lot of structure. So to me, you have to look at what are you actually buying, what is the liability sitting out there in that kind of business, and how do you structure something that makes sense, right? Because the seller wants one thing, the buyer wants a different thing. Asset is always, most lawyers were going to drive at asset deals because it's the easiest way for us to structure and to get out of liability and to build an indemnity clause, but it's not always the answer. And you have to kind of go with whatever kind of structure is just going to work for that transaction just to get the deal, not necessarily just get it done, but get it done right.
So kind of carrying on from previous conversation, this is still all about planning, working ahead, and getting in front of it. Mary, is there something you want to add?
Ditto to kind of what Mark said. And when I'm first looking at a deal, the first thing, if you're going the SBA financing route, so it's up to $5 million in 7A, is SBA eligibility. And so there's something called the SBA SOP. It's about a good 600 pages long. So you definitely want to call one of your trusted SBA lenders. There's a couple of us here today. I know Jerry is here, Angel's here, myself is here, who we should be, our job is to be experts in that SOP. And so when a deal first comes to our desk, the first thing we're looking at, is this an eligible structure? So one of the first questions as well is, okay, is this an asset or a stock purchase? And so it really kind of depends on what else is included in that deal, but eligibility is a huge thing. So I won't bore you with all of the eligible transactions, because we could probably get into that a little bit later.
Yeah, I think just to add on to that from a valuation perspective, especially in the SBA, are you assuming customer deposits? Is there enough cash left in the business post-close? Is there enough working capital if you're taking a working capital loan? Because a lot of these, borrowers can really get tripped up, the first 3 months post-closing with not enough working capital in the business to actually, fund it. And then, once you're away from that table on that, that first loan, you're going to have some issues versus, especially in the SBA, right, getting a working capital loan.
Kevin, you want to go ahead, make it 4 of a kind here?
Yeah, I just wanted to get the last word in on Mark on that deal that fell apart. We started that deal before COVID, like 6 months before COVID, and then COVID hit and the client's revenue dropped relatively significantly, and the client really didn't want to lower their expectations on what they were going to spend. So Mark was a real pleasure to work with, to be honest with you, and the client's expectations were not with reality.
You're not saying pleasure in air quotes. You actually mean pleasure? Okay.
I wasn't being a lawyer at the time, so that's why it was a pleasure.
Are you being a lawyer now? Okay. So let's talk structuring, and particularly maybe some creative structuring. Can you share some examples of creative deal structures that have really helped overcome challenges or maybe added significant value?
Sure. We actually just recently closed on an electrician company that sold generators and in most states. And so we work in all 50 states. And licensing is a huge thing in almost every state. But some states require the business entity to have a license. Some require somebody in ownership to have that license. And also Brian did the valuation for this company. We all worked it. It was so fun. And so it was an electrical company where the woman's cousin was a master electrician. And so he was able to have, I think it was 5% ownership. And then her and her husband split the remainder 95%. And then that's how we were able to get an eligible structure where they could operate day one post-closing. Because if you buy a business and nobody has that license to operate, you're not going to be able to make any money like day one of closing. So getting ahead early, too, on any licensing questions. Okay, do I have somebody on my team, or is it a state where just employees have to have that license? That's also risky, too, though, because what if those employees walk? What are you going to do? How are you going to get the right license? So thinking that way, like, okay, maybe I can give minority ownership to someone. Or now also eligible in SBA is seller rollover equity, where the seller could retain 5% equity if you need them to, and they could also hold that license post-closing.
Yeah, that's actually probably the biggest thing I'm seeing, because there's so much of this. I don't know, does everybody know the term ETA? Yep. So entrepreneurship through acquisition. It's this, like, I don't call it entrepreneurship, but that's me because I'm an entrepreneur. But it is entrepreneurship in a sense, right? Going out and buying a business to run a business. But these are existing businesses that have been around. Most of them are, first generation, sometimes second generation businesses. The next generation doesn't want to buy them. And you're seeing a lot of, they're actual, I guess, reformed bankers and iBankers that are buying up a lot of businesses. I represent a bunch of them on the buy side that are searching right now for, HVAC businesses, electricians businesses, plumbing businesses, all the standards, trying to trades that, the next generation doesn't want the business. But these are solid businesses that have been around a long time. They also have they also have the dream that they think they're going to roll up multiple businesses, which, it may happen, it may not happen, but, you see a lot of that licensing issue because none of these people have licenses, and they're buying businesses that have license requirements. So now they have to buy it as a stock deal when they didn't want to. They thought they were going to do an asset deal. They have to do a stock deal because they're going to have to do the seller rollover in order to maintain the seller in the position for the license, so that they can keep the business running. So that piece in the SBA, change is huge.
And hot off the press, you can now do seller rollover with asset purchases, which is huge. This happened 3 weeks ago or so, where you can create your new holdco that buys the assets, and the seller is now retaining percentage in that entity. This literally just became eligible. Hopefully they don't roll it back. But that just became eligible a few weeks ago.
Kevin, anything you want to add?
Are we talking structure, or you want an earn-out story? Yeah,
can go that way.
when I ran a business unit for one of Carlisle private equity's operating companies, and we were looking for a tech acquisition that we thought we could scale. The company was not making money, so we had to use a discounted cash flow on future projections. And we thought the business was probably worth $10 million, which is what we bought it for. But we gave them a $40 million earn-out payment, and that's the biggest earn-out I've ever seen, to be honest with you, over a two-year window. So we had a global organization. So if the product was going to work, we would be able to scale it. Unfortunately for the seller, we couldn't scale it because it had a couple of technical issues, but that was a way of at least giving the seller a chance to ramp it up using a creative, biggest earnout I've ever seen.
Yeah, I think with the rollover equity too on the private equity side, or larger deal structures, I think when we work on the sell side, educating the seller on what that rollover equity really means, because a lot of time, you're not pari passu with fund coming in. So we've worked with a lot of doctors, right, in these roll-ups, and they think that the preferred stock is $60 a share, whatever value they've ascribed, that their common equivalent is worth $60 a share. Meanwhile, there's a hurdle rate. There's you're not pari passu, right? So just educating what are you actually getting on that rollover equity, because the number that is ascribed to it might not really be the economic value.
Great, thank you. The lawyer has to go last on this one, and you'll see why. So if we look from a negotiation perspective, because he'll talk forever, how do you approach negotiations to ensure alignment between buyers and sellers while maintaining flexibility in deal terms?
It all starts with the letter of intent. Is this supposed to be me, or was it supposed to be somebody?
I said you go last.
Oh,
but
I go
that's okay.
last.
Yes,
Okay.
it's all right.
Kevin's going to go first.
Go ahead, Kevin.
I don't disagree with you. First of all, we usually start with an indication of interest to do a structured sale process, which some people would call an auction, but we're trying to cull down a list from, let's say, 50 down to 10. Ideally, we get 10 indications of interest, and then we continue that with a management meeting or call. And that LOI is really important. The detail in the LOI can minimize surprises in due diligence if you get all the terms written out really well. So I agree with Mark.
And if you know, sorry.
Okay. Go ahead, Mary.
If you know, like from the get-go, you're going to go the SBA route, talk to your SBA lender too, making sure that LOI is going to be structured properly before both parties sign it. Everybody's hitting the ground with due diligence, and they're like, wait, this doesn't work, this isn't eligible. Even with things like with seller financing, talk to your SBA lender, making sure everything cash flows together. There's been like a number of deals I know that Mark and I have worked on the front end, and we're like, wait, let's tweak it here to make it more eligible. Yeah, I would just talk to whoever your financing partner is, make sure they're okay with that structure. So then that just avoids a lot of frustration on both sides.
And I would just say, too, from an estate planning perspective, make sure that's all in order before you enter into even an LOI. We work with a lot of founders where maybe they've made some gifts, some estate planning post an LOI, and it becomes very difficult to support that the value of that company is worth less than maybe the indication of offer. You can be creative with it, but the best time to do that, planning around, the equity that you have is prior to any indication of interest, because the IRS is always going to look at that as the strongest indication, of value.
Go ahead, Kevin.
I just wanted to say that don't assume the first-time seller who might have started their business 30 years ago, and maybe they got it to 10 or 15 or 20 million now, they don't even know how to spell M&A if they've never done a deal. So it's important on the advisory team, and I say team, that we educate the seller as best we can, so when it's time to review that LOI, and at Murphy McCormick, we can review it really well, but then we encourage them to have their attorney review it as well, to make sure it's in the legal language. It's good if they've got an attorney that has an M&A practice area, or that's an M&A practitioner on their own. But don't underestimate the importance of, especially the smaller the deal size, that you spend a lot of time educating the seller.
You can go now, Mark.
Oh, thanks. Yeah, I think that, I lost my train of thought, so it doesn't make me matter at this point. You lost me. No, I didn't. It's the IOI is kind of like, the critical piece, the IOI and the LOI, and the problem is that a lot of times that we get brought into a deal, lawyers, by the time we're brought in, there's an LOI that exists, right? Somebody already negotiated it. They've already decided what they're going to do. They already made all these decisions, and now we got to walk it back, right? And it's just like when Mary said, there's SBA requirements that you could negotiate something, and then you find out, well, the SBA is not going to approve it anyway. Now we got to take the seller and walk something back. So if the earlier you can get the professionals involved in the deal, the better off you are, because then you're not going to have these positions where that's where negotiations go really, really south, right? Because you have expectations that were created in the seller. The seller now thinks, oh, I'm going to have a job for the next 3 years, and they're going to pay me, and I'm going to be sitting on the beach for 20 hours for half the time, and then I'll just have to call in and work a little bit. And then you find out, well, the SBA is not going to let you do that. You can't work, you're not going to work past the 12 months. And you're going to be here. You're not going to be on the beach. And the seller is now pissed off because they thought they were getting something that they can't get. Now they want something more in reaction, right? So it's always a give and take. So if the more you can try to play that game in the beginning, when you're writing the LOI, the better off you're going to be.
Great, thank you. We're going to pivot to valuation. Next part here. Two-part question, and Brian, we'll start with you on this one. What are the key metrics or methodologies you rely on in determining, a fair valuation? And then part two, how do items such as customer concentration, add backs, QOE, QOD, and issues with cash figure into all of that?
Sure, yeah. I think you mentioned QOV, right? So at the end of the day, any valuation is only good as the accuracy of the numbers behind it, right? So you have smaller businesses that are maybe on a cash basis, right? Getting them over to accrual, understanding really the true earnings potential of the business. Because, mid-market, right, the rule of thumb is to put an EBITDA multiple on that. Well, what really is EBITDA constituting of? Is it the historic performance, the expected performance coming out of, COVID? There's probably some non-recurring events there, right? So, any valuation is predominantly based on future expectation. I think psychologically it's easy to put something on a trailing 12-month. But to your point so with the QOV, right, you get accurate financials, and then generally, we're looking at precedent transactions in the marketplace, whether that's in the public market, private market, potentially a discounted cash flow, as alluded to earlier, right? But a lot of those times with, a projection-based valuation, right, there might be an earn-out that needs to bridge that story a little bit if it's not guaranteed by a contract.
Go ahead.
Sure.
Yeah, Kevin.
I think I'd like to make a comment from the first panel on valuations in general. I recommend, because I did a lot of strategic acquisitions as a corporate guy, that companies take the time to do a valuation almost like they do as a 3-year strategic plan. And if the business owner's in their 40s, that's probably a good time to start, even in their 30s, because if they find out what the business is worth, that may shape their strategy on what they're going to do to increase value over time. So I'd say at 30-something, 40-something, it's never too early to start on a valuation. What was the question?
Key metrics and methodologies and how
the
other factors.
methodologies, yeah. IRS 5960, we follow for a fair market valuation, and sometimes if it's a stable business with stable cash flows, maybe growing at GDP, we'll use a capitalization of earnings methodology that's risk-based. The risk can include client concentration, sloppy financials, or they having the financials audited. We've had a case where there was some unusual accounting on a client. We told them we can't take your business to market unless you have a quality of earnings done for us before we go to market. And the client unfortunately was in his 70s and never had a valuation on the business, and he died of pancreatic cancer before he could have the evaluation done. So back to my point about why you should have a series of valuations done, maybe every decade or something like that. So the other technique would be on a growth. If a company has good growth projections, the discounted cash flow technique is another valuation. And then we usually do comparable transactions type analysis or comparable industry transactions as well.
And I actually think just one point there, Kevin. I think what you said, two things there actually point to a broader topic we often advise our clients on, which is build your company as if you're going to sell it, even if you don't plan to. And a couple of those points you got to there. So if you have to, you're in that position. And I just think you hit on a couple of those points when you talked about the valuation and some of the other items.
I think it's a really good comment to get a valuation completed, because a lot of these private business owners, it really accounts for the majority of their net worth. So you get a brokerage statement every month that tells you, what your stocks are worth and all that, and they have no idea sometimes what their business is worth. And through that process, they can figure out how to increase the value of that business, and they can also figure out, well, what I'm paying myself out of this business is how I'm used to funding my lifestyle. Would a possible sale of that business continue to fund that? Because those can be two wildly different things.
Okay, great. So let's go to the kind of intangible side to this. So how do factors, the intangible factors such as brand strength, culture, intellectual property play into the valuation process, or do they?
I think it's often misunderstood. So if you think about even at the SBA level, right, a liquor store, and it's a going concern, it's generating cash flow, and there's this misunderstanding sometimes that the value of the business, the value of that liquor license is not in addition to the value of the business. The value of the business is based on the cash flow it generates. You cannot generate that cash flow without that license. So the same thing to a brand. When you look on the public market, you look at Apple's market capitalization. That includes the value of its brand, because its brand is driving its earnings. Its brand is driving its growth. Now you can distinguish hypothetically what the value of the trademarks are in that value, but those things are not additive. I think the only thing maybe to be aware of outside of that, maybe if they are developing intellectual property that has yet to be monetized. But if you are, in a simple way, putting a multiple on EBITDA, and that EBITDA is based on those customer relationships, that brand name, that technology, then it's going to be accounted for in the valuation, theoretically. I don't know if you have any thoughts.
Just, I'm not an expert on the valuation of the intangibles, but we did sell a distributor that sold industrial products, not a box-moving distributor, somewhat of a value-added distributor, but they did have a solution of their own that was private labeled under their brand. And I think that brand that they were selling had slightly higher performance than the generic Me Too products they were selling at a lower price. I think having their own branded product as a value-add distributor helped get maybe a few more points on the value of the business, maybe 5% more.
Yeah, I mean, to me, valuation is whatever somebody's willing to pay for it, right? The buyer, whatever the buyer is going to pay, that's where the valuation is going to come in. These guys are going to help figure out, like, what's the real numbers? What do the real numbers show? Can you justify it for the financing? But, a lot of times you're representing a buyer. It could be a corporation and doing a strategic deal. They may see value in something that is the intangible, and that's where they might just want to buy their way into a market. And they may overpay to get into the market. Now, that's different because they don't need an SBA loan. They don't need financing. They're going to finance it on their own. They can overpay. So you will see deals where valuation is higher than you would think it would be, and it doesn't make any sense to you. And you look at the deal. So if you look on Crunchbase or PitchBook, and if anybody that tracks it, you got to look at deals all the time, because you should be looking at numbers all the time to try to figure out what's going on in the market, especially in the market that you're in. I think your point of having a valuation around your business is it's phenomenal, right? You can't get enough people to actually do that. But if you did, and then you were looking at data, because there's so much data now in terms of what deals are being done and actually reported on, or at least you can get some snippets of deals and try to piece together what's going on in the market, you can really start to drive your own valuation. And you can also figure out, is that intangible going to do something? Obviously, if you have a patent or something, like Brian was saying, if you have some developed technology that hasn't been monetized, that's got to get valued on its own, right? There's people that can value patents and figure out, okay, you developed this technology, it's worth something extraordinary. You know, I have one of my companies we have a titanium extraction methodology that's different than everybody else's. I think it's the greatest thing that's ever been invented, right? I think the patent's worth $100 million. Now, is anybody going to pay me $100 million? Not a chance in hell right now. But do I think I can get it there? Well, certainly going to give it a shot. But that valuation is based on my inherent belief that it's going to be a game changer, right? So if I find a strategic that says, wow, that really does have that capability, they may overpay right now and buy that technology from me. I hope they do, because I don't want to work anymore.
Go ahead, Mary.
Yeah, no, I was just going to add that it also really depends on who the buyer is. So when it comes to the financing, every SBA loan needs a third-party business valuation that the bank engages. So if somebody comes to me and like, oh, I already got a business valuation, I'm like, that's great. I need to order one too. So it's great for you to get a feel for the numbers and look at everything. But I, as the lender, still have to order that third-party valuation. So the SBA does have some guardrails around that. So if the financing amount is larger than what that valuation comes back at, we have to lower that financing amount to equal that business valuation. But let's say you have a $4 million business valuation and your loan amount is only $3.5 million because there's some seller financing, some personal equity injection into the deal, we can still move forward to closing even though the value came out lower. However, every credit department is going to require that buyer to explain intensely why they still want to buy that, why it hasn't valued out. And there could be a number of reasons. Let's say it's, I was just looking at a government contracting company. They do IT consulting, and she's able to pick up all these other territories if she buys this other business. So even if it doesn't value out, she's looking at it as an opportunity rather than, oh, I'm just buying this and I'm running this full time. So, and that's where we would look at more like expansion type projects and deals. So it really depends on the buyer. But the SBA does have some guardrails, and most lenders in the country probably wouldn't lend to you if the valuation came out lower. You have to be very strategic of why you want to still buy it.
Mark brought up intellectual property or patents. I've seen a company that has a very solid patent position, a patent portfolio, and that significantly increased the value, especially because they were collecting royalties on it and defending it in the courts. So that if they just have patents for the sake of writing patents and they're not enforceable, that's one thing. But if the patent's so strong that they're collecting royalties on it, you can bump up the value of that business.
I also think the point earlier from Mark is well taken. You know, what we do in evaluation is, you know, generally an academic construct, right? It's based upon regulations, whether that's from the IRS or GAAP. And, you know, we advise, for example, on a sell side, you know, they had an interested buyer, literally on a normalized basis, doing $100,000, $200,000 in EBITDA. They had about $2 million offer on the table. So, you know, one of my things that goes off in my head is, well, why do they want to pay $2 million, right? What are we missing? But beyond that, going through the valuation process can get that buyer comfortable that, yeah, $2 million is a good offer. And you can also, you know, a lot of times, if we come up with a value, I would encourage them to ask for more than that. You know, start there, right? There's an art of negotiation there. And understand, you know, your fair market value and your investment value, because if there's specific buyers in mind, there's going to be expense elimination. And so that's going to increase your cash flow. So don't sell yourself short if you can get a piece of that. And then on Mary's point, we do see where maybe it's an investment synergy acquisition, and that gets tougher for banks because they are paying a premium that perhaps potentially the historic cash flow of the business can't support that new debt. So I think it's always important. I don't know if you want to talk about that point, but, you know, we've worked on a few deals with her where, you know, trying to work through those issues can take some time.
So I'm just going to move us into funding, a little bit of funding based on that. So we know deal sizes, complexities, challenges, they're going to run the gamut. Obviously, so do the funding options. What are those options and considerations from Main Street to mid-market? Want to start, Mary?
SBA. SBA 7A up to $5 million is a huge asset for smaller business acquisitions. And so it doesn't necessarily mean your total project costs are $5 million. That's your max loan amount. So we've seen projects that are $7 million, but then you have a $1 million seller note, A lot of private equity investors on the side contributing that million, and then the 5 million SBA loan. Sorry about my voice. And so, yeah, that's like the best funding. And for funding wise, in the SBA or any bank, really, cash flow is king. So yes, with the valuation metrics, you can look at goodwill, you can look at the patents, technology, the people. But for us, like, if it doesn't cash flow at a certain debt coverage ratio, we just can't do it. And so the SBA does have a minimum that every lender has to abide by, which is 1.15. And then there's usually, you know, depending on your deal size, more than that is what the lender wants to see. It's a hard deal if you're right at that minimum, because one difference in analysis or something could really put you under there. So a lot of lenders out there are going to want to see maybe a 1.25, and then there's also different years worth of that. So at our shop, we like to see the last 2 periods. So what that means is your last tax return filed plus your interim period. Now, I don't want to see like January cash flows and then my tax return last year cash flowed. I would want to see, okay, I want 24 and 25. Sometimes there's story behind that numbers. Let's say they got 4 new amazing contracts and then we can look at the future and some projections. But if there isn't a story behind those numbers, we're going to want to see multiple periods of cash flow. And that's where, too, there's the beauty of tons of different SBA lenders in the country, because we all have different requirements for that debt coverage ratio. Sometimes it depends on the industry. Sometimes it depends on the buyer's post-closing liquidity. So I think it's important to work with a lender who's very creative in that thinking and can tell your story really well.
Yeah, I think the funding piece of it really, it really is how big is the deal, and what's going to drive it. So as you get bigger and bigger, the deals get more and more complex, and there's a whole lot of different pieces to it. So you have, it could be a private equity transaction or a leverage buyout transaction, and you end up with an equity infusion coming in, and that equity could be coming from multiple places. It may not just be one place. There could be multiple different equity sources. Then you're going to have a senior lender, you're going to have a mezzanine lender, and you hear all these terms, and senior debt and interdebt and intercreditor, and it gets super complex, right? And that's when you need really good lawyers and accountants and people around you to understand, okay, what does this all mean? And that's whether you're on the sell side or the buy side, because if you're on the sell side, there's a lot of risk to you now that they're doing. When you start to see a deal that's getting structured and it's got, okay, they're going to put in, they have a senior lender, there's a mezz lender, oh, wait, they have 3 different equity sources they're trying to raise capital from. Are we actually going to get to a closing? And that's a big question, right? And that's a big piece of it. So, like when Kevin and I worked together, I was at an independent sponsor private equity firm that I'm no longer with, but part of the problem is as an independent sponsor, we were raising money, right? We came to the deal, we say, oh, we're going to put this deal together, and we financially engineer something, and it looked beautiful, right? We could put a great spreadsheet together, we were great at it, but we don't have any money. So you have to have, knowing who the buyer is and does the buyer actually have the capital to get the closing is a big piece of it for the seller side. And from the buyer side, it's also, you want to try to get a deal done, you want to do a deal, you got to know where you're going to get your money. So talking to financing people first and getting everything really in a row and getting your ducks in a row and figuring out, okay, I have equity from here, I have this piece, I have this piece. But when you're there's a lot of independent sponsors running around. I'm not knocking those set of people, because there's a lot of purpose for it. I was one, right? It's fun to do, but it is really hard to get deals done. So that's why, true traditional private equity is a lot, they come to the table with a large fund, they can write big checks. Usually they have debt financing all lined up. They might even be doing it themselves. So there's a lot to it to look at it that way.
Great. Yeah, interesting deal I got right now is a strategic buyer that is all cash. I haven't had all cash in years. But that's the way they want to do the business. They're flush on the balance sheet. The seller hates the idea of seller note. We've got another interested party that wants a 30% seller note, and they'll probably take a lower deal just so they don't have the concern of the seller note. One of the sellers is 70 and the other is 60. The 2 partners. So again, it's. Now, that strategic buyer also has a couple of manufacturing plants not far away, so we'll try and work a little benefit of the synergies we can see, even though the buyer is going to want to keep all the synergies for themselves. But every deal is totally different. Private equity these days looks for rollover equity from my perspective, and also for the seller note as well.
Great, thank you. So we all know businesses have incredibly realistic expectations of how long the process is going to take, because it'll obviously occur in a month. That's how these deals go. So let's go to time frame. What do we realistically need to be thinking about from a time frame? What are those key activities, key actions we need to be thinking about that are going to influence, the duration of the process?
Sure. So, well, it depends. Like, are you just starting to look right now to buy or sell your business? That can take years, or that could take a couple months. I think there's like a huge timeline there. So I'm going to really just focus on like if you're pursuing the SBA financing route, like a rough timeline. A lot of us, we usually say rough timeline is like 60 days, but that's after you have a signed LOI. So then there's a bunch of stuff that goes on before that signed LOI. And I had the pleasure of working with Mark as a buy-side attorney a few months ago. My husband, we bought a small business, but it took him, gosh, I think we were searching for like a year before we found one that really worked and that we really wanted to buy. And that cash flowed well and that we were able to afford. And so that process took a year. And then once, you meet the seller, I think this is just an example. So this was a smaller size business. In August, you meet the seller, you get an LOI, everybody's getting along great. And then you choose a lender to work with. And so I worked with another good friend, and that we flew through the process, but that's because I'm an SBA lender too. That is not the norm. And our whole process still took, I think it was maybe like 90 days, just because there was a lot of back and forth with the final purchase agreement. And Mark was so great because I'd be like, what does all this mean? And he's like, yeah, it doesn't matter. Like, there's certain things that really matter that you want to fight for, and there's certain things that don't. So you want to work with an attorney who's not going to like nickel, depending on the size of the transaction, of course. But you don't want to go through every comma and remove it if you don't have to, depending on what your priorities are. And so it was a smaller one. We wanted to get to closing in a certain time frame. And so typically, like for us, if you have signed LOI, we'll run through the gamut of getting you a term sheet. That usually takes about 2 business days. Once we get that signed term sheet, and we call it a short needs list, so all of the financials of the buyer and the seller, and you sign that term sheet, then we go into underwriting. For us, that takes about 5 to 7 business days as a full underwriting. Again, different. Every SBA lender in the country has a little bit different of a process, but we're all roughly the same. And then closing. So closing's pretty much the same everywhere, where once you sign your commitment letter, that lender is going to give you a closing checklist, which includes purchase agreement, all the exhibits on that agreement, insurance. It's everything that you need to be able to close that file. Once you get all of that in, you can close a couple days later. So the ball is in the buyer and the seller's court and their attorneys for most of the time, actually. So like if you're on top of everything, responding back to your lender, responding back to those third parties, you can shorten that timeline. The fastest acquisition I ever did was 18 days, but it was like insane speed that everybody worked. Averages is around 45 to 60 days. But yeah, I guess like the biggest thing to know though is like the ball's in the buyer and the seller's court if they know what they need to get the job done.
I would say non-SBA deals are much longer. Like we
Well,
can.
that's really encouraging.
Yeah, they do not
Everybody
close.
hear that?
They do not close in 60 days. I can't get deals done. I mean, I try, but it doesn't really happen that fast. I would say 120 is a better number for most deals that I see, and some of them are dragging longer and longer. It really depends on who's doing, who the buyer and who the seller is, and what the financing looks like, and if there's how complex is it and how many different pieces are there, and that kind of drives it. I know that's a standard lawyer answer. It's, well, it depends, but it really does, because it kind of is like there's just kind of tiers of things that go on. And I would say the SBA is great because it has, very definitive checklist, and you cannot do any, like you can't go to the next step, which I love, because you can force the buyer and the seller to do something, because you say, well, we're stuck. Right? You do this or we can't move forward. And in a standard transaction, there is no like recipe that says, okay, I can say it because I'm the buyer's attorney. I'm saying, hey, we can't go forward because we don't have this. And the seller's attorney is somewhere and not listening, or nobody cares. And then you say, well, the deal can't move forward. We got to get this done.
we started client engagement with a valuation for planning purposes, which is not a certified valuation, even though it gets to the same number, but it starts the relationship. And we also give them, which I have a few copies with me, or if you give me an email, I'll email it to you. It's time-tested, 10 years old, preparing your company for sale, 10 steps to take now. And if in that valuation for planning purposes discussion, we'll talk about the valuation, the cash flows and the debt service coverage, and we'll give them the likely buyer universe, private equity, strategic, solo investor, our marketing plan, and so forth. But if we see a lot of areas for improvement, we're going to tell them it's too early to go to market. You need to spend a year or 2 or 3 getting your business ready, following the 10 steps we have here, because we don't have time to fail. We don't want to fail on their behalf or our behalf, because it's just wasted time. It's an opportunity cost situation. If they've got to improve their business, whatever they've got to do to it, we want them to do that. So, but to get to the question. The strategic buyer I'm talking about, all cash, they're going to do that deal in 60 days. If it needs bank financing or other type of investor financing, I think that adds. It's probably going to more like 90 to 120, and then in due diligence, if usually all deals these days, if they haven't had a quality of earnings done in advance. They start the quality of earnings not in sequence with everything else, or not in parallel. Quality of earnings first before they do anything else, because they want to get the numbers question out of the way before they'll put a whole team on it. So that adds deal creep. I think that can add it to go beyond 120 days, like Mark said.
Great.
That's a good point on the Q of E. I think we're on the 3rd month of a Q of E right now on a sell side. And the time it takes, obviously, is based on the complexity of how you plan to take it to market. But this is a carve-out. There are shared employee costs, right? It's a portfolio of companies. They have overlap costs. So to drill down on what the true P&L is can take some time. So I guess to your question, like how long does it take? It's when do you define starting? But the more complex that deal is, the longer it's going to take generally.
Yeah, and Kevin's point's really good because that is the deal creep, right? And I've been on the buy side, and the buy side will shut down everything else, right? They'll say, oh, the quality of earnings is taken 60, 90, we're at 60 days, we're at 85 days. I'm not looking at anything else until that's done, because it's, why am I going to spend any more time? Why am I going to spend any more money? They shut the lawyers off. They shut off the other accountants. They shut down the cybersecurity look. They shut down everybody, right? And so now the deal's basically shut off until quality of earnings is done. And now you got to ramp everybody back up. You got to remember everybody's busy. They have other deals they're doing. Next thing you know, you say, well, can you get this deal back on? And the attorney's off doing something else, and they say they'll get to it, and a week goes by, 10 days goes by. Now they're back in it.
Just one last point. I'm talking about LOI signature to close. But when the investment banker gets involved after we kick off the engagement, there's probably a minimum of 2 months to get prepared and get LOIs in. I mean, that's fast. So I think we're talking 6 months to a year before, from the time of the first meeting to closing the deal, with all the creep going on in due diligence and finding the buyers out there. Not everybody's waiting for my call. You know what I mean?
So I know we talked in the last panel a little bit about due diligence and came up. I'd like to hit on maybe common red flags you come across, and how do deal makers typically address them or work with them?
On the SBA side, I can specifically, Mary can probably attest to this, right? But when you're working with the broker and they're adding back every expense, and that's how the purchase price has been justified, and the business doesn't need employees, and it doesn't need rent, and it's great, and that would probably be the biggest hiccup, essentially, on the SBA front. I don't know what you think to add.
No, for sure. And for add backs too, it's tricky because everybody's like, but add backs, that counts, right? What the seller is spending through the business. And so the first thing that I look at when I see those add backs is a new buyer going to have those same expenses. So yes, this seller is putting their health insurance through the business, and they're using that as an add back. But is our buyer also going to need health insurance through the business? If they're not, if they have outside health insurance, okay, yes, that is an add back. So sometimes like the buyer really does play into effect with that value or with what the loan could cash flow for. There's add backs like, oh, well, my Aunt Susan is the accountant and she works like 2 hours a week basically on this. Okay, could you absorb that? Yes, that can be an add back, but I'm going to need to see a W-2 from Aunt Susan to qualify that. So the biggest thing that we ask for when looking at add backs is documentation. Can it be documented? If you're putting all of your car payments through the business, send us those statements and show me where it lines up on your expenses on your tax return. So it's a lot of just like crossing and checking when those add backs get to be a lot. And you really like, I guess it depends on the size of the deal, but if you have like 20 different categories of add backs, is this business really worth what it's saying it's worth? Like the standard ones that we look at mostly is, your net income on your schedule M1. We use that number and then we're adding back depreciation, interest, amortization, and then the owner's compensation. But then we also have to discount that depending on what our buyer needs to take as a salary. We do see a lot of deals, especially recently, where that buyer may not need a salary right away or they may need just a little bit less. I always build in something, even if they have $300,000 of outside income and they're buying this business, maybe you include $20,000. You still include something because nobody buys a business to make nothing the first couple of years. It could be a strategic thing, but they need to make something for them to be invested into it. So even that officer comp line, I don't add back 100%. It depends on who the buyer is.
Yeah, there's a lot of other pieces besides the valuation that pop up in due diligence that you need to take a look at. And I traditionally start HR because HR to me, employment is really where your biggest risk always sits, right? How did they handle their employees? What do the employee files look like? And that tells you so much, right? You don't think it does, but I can tell you when you walk into somebody's office and I've gone in and there's stacks of folders like this with employee data in them, you know what you're dealing with. You automatically know from the beginning there's a problem here, and I got to go find it, right? Even if there isn't a problem, it's the audit, right? If something's a mess, then there's probably a mess in there somewhere, and I got to go find it, and I got to figure out what it is. And I go from there. I go to contracts because you're trying to figure out what contracts do they have, what do they look like, do they even have contracts when they say they have contracts? Most of the time, stuff's expired. It doesn't exist. Oh, I did a deal with them, and they're the largest customer, and we've been working with them for 20 years. And the last agreement was written 20 years ago, and it didn't renew. So there is no contract with them. And now you have a real problem with the valuation because the valuation was based on that client and that customer being there. So it's really, and how do you mitigate it? You mitigate it through just knowing that it exists and talking through it, right? You have to find all this stuff, and that's what the data room's for. That's why data rooms are great. It's, I'm old enough that I existed before data rooms, right? So when you used to have to just go to some place and just pull out all their files and just dump it on the table and start looking at stuff, now everybody uploads everything. So if you can keep a clean data room and you can kind of figure out, go through it one at a time and just start flagging things. And there are red flags all over the place. And it's a matter of how red is the flag. Is it something that's a deal killer, or is it something that we can actually say, okay, we can figure out how to work through that? I was looking at a company and we thought everything was great, and then all of a sudden we found one piece of paper hidden in all their HR files. They hadn't paid workers' comp insurance, and it was a manufacturing plant. They hadn't paid it in 4 years. That's a killer.
I'm going to have to stop you guys because I know we could go on for this forever, and what I'm going to do is encourage folks. I know our panelists are going to stay up here afterwards. Please come up. But we do want to allow some time for some Q&A from the audience so they have a chance to ask this group any questions. So does anybody? Great, I'll bring it up.
Just one clarification. How you doing? The gentleman said IRS 5960. Is that what you said?
Yeah.
And that's fair market value?
Yes.
Okay.
I'll let the CPA answer that, though.
Oh.
It's how the IRS would like you to value a company for tax purposes. Yeah.
I think it was named 5960 because that's the years it was invented.
Yeah, I think 59. It actually, yeah, he's correct. It's, I think 59.
One of the panelists said that the businesses when you guys were talking about the brand, and then that contributes to the value. What about these businesses where they tell you that the value is a multiple of the earnings, and then plus inventory? Then they want the inventory. How do you guys value those types of businesses, or do you make allowances for certain categories?
I see that a lot with liquor stores, and I think it's the same issue, right? So yeah, it's not well. You can bifurcate the purchase price to make it additive, but at the end of the day, you need inventory to run that business. So if you're not acquiring inventory on day one, you're going to have a large cash outflow that's going to negatively impact it. So we look at it, normalize inventory. What does the business need compared to its peers? And then the other good thing about it too is we can just completely make that irrelevant, because when we look at the transactions, we can strip out inventory completely from the purchase price, get it an equivalent multiple, then add your inventory back, right? But yeah, it's a common kind of problem with those valuations for the liquor stores.
And in other industries, I have a deal right now where the purchase price is $2 million plus inventory. So the EBITDA multiple is for $2 million, but then inventory is estimated at like $120,000. And then what usually happens is like a few days before closing, depending on what that business is, you do an inventory count with the seller, and then plus or minus, you pay the seller what the actual amount is.
Any other questions?
So then that actually raises the valuation in some cases, right? If you listen, right?
Well, yes and no, because it depends on the valuation. So, like, if you're buying, you would have to buy that inventory. So you're just paying the seller for inventory they've already purchased for you to sell on day one, right?
You know,
That's how I look at it.
So very confidently. Generally agree. I mean, if you're getting a good deal, right, if you structure it correctly and you're getting excess inventory, I could say, you know, that's an advantage to the buyer, right? So what's the historical needs of the business been? What's the inventory they're acquiring? And, you know, an astute seller, I think, would normalize that, but, you know, here and there it slips through.
Hi, Michael Hood with Valley Bank. Just, I like what Kevin said about always having some sort of valuation on the shelf just in case you need it. But as a business owner, maybe I would like to think about the other side of that, and, you know, could you potentially open up Pandora's box, especially when you have a group of owners and somebody gets a hold of that valuation? It's like, oh my God, we're worth what? I'm selling right now. Do you have more risk in kind of opening up more trouble than what you have to gain on that?
The valuation is for the benefit of the business owner and the partners. I mean, if the partners don't get along, that's a different problem. If they don't trust each other, that's a problem. But the valuation is that point in time that business is worth $10 million. They're going to do some strategic things in the next 3 years to try and get it to worth 11 or 12. But the point of knowing what it is today, they can make strategic actions to improve it.
I think you're also talking a little bit about corporate governance, right? And Mark, maybe, you know, do you have a buy-sell agreement in place? Is there an agreement between the members on how that would happen, right? So you don't have to sell the whole business or get into a lawsuit. So those are things sometimes we'll help with too, from, you know, a buy-sell perspective, put an evaluation on it.
Yeah, sometimes you have agreed upon values within your shareholders agreement or your operating agreement, and you're going to have insurance that's going to back that. So, you know, really the big piece is not, you don't anticipate that the partners are going to hate each other, but that happens all the time. What you anticipate is, you know, what if one of them gets hit by a bus? What happens then? What does their family get? And if you have valuation sitting around, then you have something to go off of. But that valuation may be so big, and they don't have enough insurance to cover it. Now you have a huge gap, and you could put the company in bankruptcy. So you have to really think about, you know, as a shareholder, what does that agreement really look like?
The insurance thing is interesting too, and just maybe something. Oh, I'm sorry. I just want to make sure that people understand. If your company has officers' life insurance and it's going to that company and the company's a beneficiary, there was a recent Supreme Court ruling where that is an asset to the company. The redemption policy is not a liability. So if you are dealing with a large taxable estate, right, the Conley case, you can run into an instance where that is actually penalizing you for no benefit to the surviving shareholders. So just there's other ways to maybe fund that if something happens, like a cross purchase agreement or something else that gets you out of that position. But that's very recently was ruled by the Supreme Court.
Great. We've come to time. Really appreciate it. Want to thank our panelists for everything. And I'm going to turn it over to Martha for a close.
I love it. So long story short, don't show up without a team that knows what they're doing. Don't take like your injury attorney to value your business and do your M&A deal. Thank you, everybody. I think this is the end of our panel, but we do have some opportunities to hang out and do more networking, but we wanted to mention a few more sponsors, give them a chance to highlight their businesses, make sure you guys know what they do. So the first one, Matthew, is actually with them. All right, and you got to hear them on the panel, so I'll let you talk about your business, and then we'll bring up one more after that.
Sure. Thank you, Martha, and thank you everybody for attending. Brian, great job on the panel. This has been a really wonderful event for us. It's really great for us to be able to see some of the SBA lenders that we work with, and then some of the investment banking clients. John Lee's here, some of the other private equity clients. A lot of the people, Zoe Combs came up to me earlier and said, hey, I would love to get lunch with you and understand where else you guys can be a resource, because so many people here know us just as a valuation firm. So Brian and his group, yes, they're doing the SBA 7A business valuations, purchase price allocations, fairness opinions, but we are a full-scale national accounting and advisory firm. We're performing transaction advisory services as well, so quality of earnings reports. We are expecting a very active 2025 and 2026, so hopefully we'll be a resource for you guys in the future. But looking forward to connecting afterwards for some drinks, and thank you for attending.
Awesome. Thanks, Witham. All right, and then we have one more. I love this also. I love the insurance plug, by the way. If you need that Keyman insurance, I got a guy. For that. I could hook you up. Our next guy is from Live Oak Bank, and a great. I don't see him actually. Is Jim Vigna around? Here he is. Oh, okay. All right. Jerry's stepping in. Yes. I was like, I know Jim. I don't see him.
No, unprepared, but thanks, Jim. So Live Oak Bank, most of you, I know a lot of the faces in this room, so most of you know who we are, but quick recap, we're the biggest SBA lender in the country for several years now. We're the biggest M&A lender in the country for deals 2 to 10 million. And the reason behind that success is really, our bank was founded in M&A, business acquisitions, mergers. So our whole credit policy is written around that. So your traditional banks, of which I spent 2 decades working for, really bankers can do a good job and present that deal in one way, and only to have a credit officer tell you, no, we don't step outside of our box. The other secret sauce that we have is we have access to our credit officers. They're open to creativity. And then the last piece is we're cash flow lenders, which is really what M&A is all about, right? Not having the collateral there. It's all goodwill. So if you don't have partners that understand that, it can be a real challenge to make a deal work. I mean, structure helps. Great partners and other bankers and everything like that, helps. But, the bigger deals, that gets more complicated when you don't have that collateral. So I would say that those are the key points of, why we're so successful in this M&A space.
Thank you. Thanks, guys. All right, my last intro, and he'll probably mention a few of our others, is the one and only Kyle. So we all know him. Do I see him? Where'd he go? Where's Kyle in his pretty purple lapel? There he is, the sharp suit. All right.
Thank you very much. How was it, guys? Had a good time? Got a lot of good information? Love it. I love the folks that stick around, because these folks actually get stuff done. You came here for the knowledge. You're going to take it away. You're going to implement. So I appreciate you guys for hanging out. And we're going to be hanging out a little bit further. Who's going to hang out with us later at Harper's Garden? It's a 2-minute walk. It's 7 o'clock, 7 p.m. So I want to thank everyone that came out, especially those that drove from far away, took the train to attend our forum here in Philly. I want to thank all of the panelists that came and spoke, the moderators, and I want to thank our sponsors. And I'll give a quick plug for Valley Bank. We have Michael Hood here. The refreshments that you ate, the drinks, is courtesy of Valley Bank, so make sure it gets information. You guys heard from Matthew Barrett of Witham. It's because of his firm we are here. And Trulient is one of our premier sponsors. And we've done a lot of work with Trulient Bank. And they can continue to do deals. So I appreciate you guys. I'm not going to hold you all. The food is coming back out. We have about 30 minutes. You guys can network. and then we're going to break everything down and hang out at Harper's Garden. So thank you guys for coming out. I would say, though, if you have not, it was your first time hearing about Eminae, we're going to be around. We're 6 years in business, newer to Philly. If you're interested in being part of what we're building here, reach out to us. Stop by the reception desk and learn to be more involved. Looking for deal makers, professionals, and business owners who want to learn more about business acquisitions and sales. Thank you, guys. Have a great rest of the evening. Thank you, panel.